I'm Brian Beaulieu, CEO, Chief Economist of ITR Economics, and today is September 15th, and thank you for joining us for FedWatch. A lot went on this week, so I'll do my best to make it brief and tell you what counts. CPI data came out for the month of August, and that showed the CPI rate of inflation increased to 3.7%. That's the second consecutive month that the rate of inflation has edged upward. That doesn't sound as ominous as it may at first appear. This is going to be a long declining trend. It's already 14 months in the making, which is a typical length of decline for disinflation. But when you start off from such a high level as we did, you're going to be in for a long decline. There's a minimum another 10 months of decline left to go, and that's really is the minimum expectation at this point. So don't get, and the Fed shouldn't get all tweaked about the 2-month bounce in the rate of inflation. The headline news is that the biggest increase in inflation was in food away from home. If people are going to eat, then they can take their inflation fears down a notch. And if they're paying back their student loans, chances are they're not going to be going out to eat as much as they were. So they'll be doing themselves a little bit of an inflation favor there. Food at home is only up 3.0%. We saw major declines in home heating oil. We saw a major decline in gas piped into the house. And I know you read that gasoline was part of why we had this surge on a month-to-month basis. But gasoline's still running 3.3% below where it was this time last year. So that's the best apples to apples comparison. And gasoline is not a big threat at this particular time, although we're watching the West Texas intermediate pricing very, very carefully. I think the more important news, or maybe equally as important, is the retail sales data came out yesterday. And it makes sense why you've been reading about, or perhaps been reading about, consumers not being in a terribly good mood. And it's reflected in the data. The August data is in nominal dollars, so it's not adjusted for inflation. But August came in only 2.9% ahead of August last year. And given the inflation rate overall of 3.7%, it's fair to say that after adjusting for inflation, retail sales are beginning to sputter. Some people are going to look at that 2.9% and tell you that the consumer still seems to be doing well. But when we look at the seasonal rise that's been going on since the March seasonal low, the magnitude of that 3-month moving total rise to date is below normal. In fact, it is right there with what happened in 2016 and 2017, both of which were recession years in U.S. industrial production. And adding to that is the fact that overall manufacturing new orders are down year over year 0.6%. And we see manufacturing production is now running below year-ago levels. In August, that 112 is also minus 0.6%. You'll read where overall total industrial production, including in the ITR trends report, you'll read that total industrial production was up, a little bit of an improvement, but that's because what was driving that was mining and utilities. Manufacturing is weakening, both in new orders and actual output. What does that all mean in terms of FedWatch? It means that, well, we fully expect the Fed's going to boost rates. I don't know whether it's going to be September or November. If the weakening continues in manufacturing and we see global weakening continuing, the Fed has every reason they can take, if they want to take this action, to stop raising interest rates. The economy is indeed weakening. They're not seeing the slowdown in wages, but that's going to follow along after this manufacturing slowdown and further deterioration in retail sales. We're going to get that wage disinflation that they've been looking for. This should be it. One more time, and then the question becomes, when will they start lowering interest rates? For now, that's FedWatch. We'll see you next week. Thank you for joining us.